2. See the full structure of a DCF model before you start building. The complete DCF formula. A DCF model has 3 moving parts: the explicit projection period, the terminal value, and the discount rate. The first term sums the present value of each year's free cash flow across the explicit forecast period. The second term captures all value beyond that period in a single terminal value figure. Both are discounted at WACC. To move from enterprise value to equity value, you subtract net debt, minority interest, and preferred stock, then add back any non-operating assets such as cash held above operating requirements. Building the model follows a fixed sequence. You start with a business analysis, understanding how the company generates revenue, what drives its costs, and how it deploys capital. From that analysis, you project revenue, then work down the income statement to operating profit. You then build supporting schedules for capital expenditure, depreciation and amortization, and working capital. Each of these links the income statement to the balance sheet and determines how much of the operating profit actually converts into free cash flow. Free cash flow is what remains after subtracting taxes, capital expenditure, and changes in working capital from operating profit. Part 2. The projection period decision. The explicit projection period should extend until the company's free cash flow growth converges toward a long-run sustainable rate, typically the nominal GDP growth rate of the economy in which the business operates. That convergence point, not an arbitrary number of years, is what defines when the explicit period ends and the terminal value begins. Different growth stages reach that convergence at different points. A venture stage company may not generate positive free cash flow for several years, and its growth trajectory may not stabilize for a decade or more. In this case, the explicit period must capture the full journey from loss-making to maturity. A high-growth company is already generating profits but is growing well above the economy. The explicit period covers the years until growth moderates to a sustainable level. A mature company already operates close to that sustainable level. A shorter explicit period is appropriate because convergence has largely occurred. A declining company requires a different approach. The model must first project a recovery or restructuring phase, then a stabilization phase, before the terminal value assumption becomes defensible. The key discipline is that the terminal value assumption of perpetual growth at a stable rate must be realistic, given where the company is in its projection at the end of the explicit period. Applying, for example, a 5-year horizon to a high-growth company and a terminal growth rate that assumes immediate stability would produce a severely undervalued result. Part 3. Where AI can help in DCF modeling. AI tools are genuinely useful at specific points in the DCF process, and it helps to know in advance where to deploy them. For business research, AI can rapidly summarize industry dynamics, competitive positioning, and recent management commentary from earnings call transcripts, information that anchors the revenue and margin assumptions. For financial data extraction, AI can parse 10K filings and pull specific line items such as capital expenditure, depreciation schedules, and working capital components faster than manual reading. For assumption benchmarking, AI can retrieve analyst consensus estimates and compare them against your own projections, flagging where your assumptions diverge significantly from the market view. For sensitivity framing, AI can help articulate the logic behind bull, base, and bear scenarios by drawing on industry news and company-specific risk factors. Where AI cannot replace analyst judgment. Where AI does not replace analyst judgment is in the core modeling decisions: how long to project, what growth rate to assume, what discount rate to apply, and how to interpret the results against the current share price. Those decisions require an understanding of the business that no prompt can substitute. For this module, NVIDIA serves as the case study throughout. NVIDIA is a high-growth company generating exceptional returns today, but its growth rate will eventually moderate as the AI infrastructure build-out cycle matures and competition increases. The explicit projection period covers the years between current high growth and the point at which free cash flow growth converges toward a long-run sustainable level.